Hello everyone, welcome to a video about money and financial institutions. How does money play a role in our daily lives? Let's watch this explanation.
To learn about money and financial institutions, we need to know about Irving Fisher's theory. What is Irving Fisher's theory? This theory builds on David Ricardo's quantity theory of money. It says that the amount of money in circulation is directly related to price changes. This theory says that inflation is caused by more money in circulation. This theory explains how price change when there is more or less money in circulation. This theory is expressed by M multiplied by V equal to P multiplied by T. V is the speed of money circulation, T is the volume of goods and services traded, P is the price of goods and services, and M is the money supply. T in the equation can be changed to Q, which is actual output. This allows more specific analysis of how real output functions in an economy. This equation also allows for a more detailed analysis of how changes in the money supply affect real prices and output.
Is classical theory? Classical theory is the development from neoclassical theory, begun by Milton Friedman and Irving Fisher. This theory is known as the monetarist group. Monetarists believe that money affects the real sector, especially at full employment. Only money affects the price of goods, so increasing the money supply raises prices. Output value remains unchanged in classical terms. This shows how the real and monetary sector differ. Money is only an entry point to the economy. We will discuss the Cambridge or Marshall equation. Have you ever heard of the Cambridge or Marshall equation? Yes, this equation emphasizes more on the speed of money movement in a given period, but on the share of income GDP released in the form of cash. The theory can be written off as if you search M or amount of money together with K multiplied P multiplied Y, where M is amount of money and K is proportion or part of GNP that is released in cash. So the amount is equal to 1 divided V, and P is price of goods and Y is transaction volume or real GDP.
In the quantity theory of money, the two most important factors in inflation are the amount of money in circulation and the public perception of price increase. Quantity theory stated that the amount of money in an economy greatly influences the level of economic activity. As a result, change in economic activity will be caused by change in the amount of money in circulation. This implies that the amount of money available in economic determines how much money is valued. The money supply increases with inflation, causing the value of money to decrease. Purchasing power declines with inflation. When a currency unit loses purchasing power, it also loses value. For example, a crop failure occurs with an increase in the money supply. This causes price to rise gradually. The rate of inflation is determined by the growth rate of the money supply and people's expectation of the future price increase. This theory included three possible cases. In the first situation, people do not expect price increase in the coming months. Most of the money supply increase is accepted to increase liquidity. The effect on the rise in inflation is very small, suggesting that the money is not being used to buy anything. In the second situation, people begin to notice that inflation exists. People begin to expect price to rise. The increase in the money supply will be used for the purchase of goods rather than for an increase in the amount of cash being held. An increase in the total money supply will indicate an increase in the demand for those goods if people expect the price of goods to increase by the previous month inflation rate. In response, they will tend to buy those goods now to prevent higher costs in the future. The third situation occurs when inflation reaches a higher level or the hyperinflation stage. In this situation, as indicated by the increased velocity of money, people have lost confidence in money. Since money loses value in a short period of time, people choose to spend the money they have rather than save it. Hyperinflation occurs when inflation is so high that currency depreciates rapidly, often within day or hour.
How does the money we circulate? Let's observe the step of money circulation. 1. Money printing is the first step. Through a central bank such as Bank Indonesia, money is printed in the form of banknotes and coins. 2. The printed money is distributed by the central banks to commercial banks. The central banks provide money according to economic needs. 3. The public use the money for daily needs, such as buying goods and services, paying bills after the money circulated by the commercial bank reaches the public. 4. The banks can get the money back from the public. How? Through deposit or debt prepayment. 5. Eventually, commercial bank money can be circulated back in the form of credits or other banking services into the public. This mechanism keeps the money circulating and meeting economic needs. Do you know the terms M1 and M2 in economics? M1 and M2 are the Federal Reserve two main monetary aggregates. M1 includes the most liquid money, such as currency in circulation, commercial checking accounts, and other liquid deposits. M2 includes saving account, time deposit under $100,000, and retail money market funds. Several variables can affect the rise and fall of the money supply. What are they? These variables are interest rates, inflation, rupiah exchange rate, government spending, foreign reserve, and money multiplier. For example, if interest rate rise, people will be more willing to save. This will result in less money circulating. In determining the supply of money in the economy, the banking system plays an important role. Banks manage money flows through services like savings, loans, and investments. There are two types of banking systems: 100% reserve banking and fractional reserve banking. We will further discuss these two systems in a case study.
To understand how banks affect money supply, let's start with the basic idea of 100% cash. In a world without banks, cash is the only form of money. For example, if total cash is $100, then the money supply is $100 too. Now, imagine the First National Bank opens and uses the 100% reserve banking system, where the bank only accepts deposits and keeps the entire amount in reserve. Under this system, if someone deposits $100 in the bank will keep the entire money as reserves, and the bank account shows an asset of $100 as reserves and a liability of $100 as deposits. The money supply of $100 remains unchanged as all cash is held in a bank as deposits. The bank doesn't create new money through the system, but they soon realized that keeping all the money in reserve wasn't effective. This is what led us to the reserve banking system. In the system, banks keep only a fraction of their deposits as reserves and lend out the rest to make money. This $90 loan is returned to the economy as cash, increasing the total money to the $190. Banks lend out new money, creating new money in the economy. Another bank, such as Second National Bank, receives new deposits and lends out most of its deposits, doing the same continuously, creating more money in the economy. The money multiplier is the total amount of money created by the banking system. For example, with a 10% reserve ratio, every dollar of reserves can generate a total of $10 of money. Thus, $100 in reserves can create $1,000 worth of money.
Fractional reserve banking creates money through lending, but 100% reserve banking does not change the amount of money in existence. Higher multiplier creates more money with lower reserve ratio. The main difference between these two systems lies in the ability of banks to create new money through lending. In a fractional reserve banking system, banks have the ability to create new money along with lending, while in 100% reserve banking system, banks only act as intermediaries for the transfer of funds between parties without creating new money in the process. The higher multiplier in the fractional reserve banking system refers to the fact that every dollar deposited in the bank creates new money through the lending process. This expands the amount of money in the economy. Banks can lend more money than deposit with lower reserves. This means there's more potential for new money creation. Thus, even a small change in the amount of deposits can result in a larger change in the amount of money circulating in the economy.
The central bank is the agency that sets monetary policy in a country. Its main responsibilities include maintaining price stability, growth and employment, maintaining the stability of the balance of payments, and maintaining the stability of other macroeconomic variables. The central bank also has other tasks, like printing money for the public and being responsible for commercial bank reserves by getting minimum statutory reserves and reserve requirements. Central banks also play a big part in managing national finances and helping the government make economic policies. In Indonesia, the central bank is run by Bank Indonesia, which is all about keeping the rupiah stable.
Is OJK and what are its functions? The Financial Service Authority is responsible for organizing a unified system for regulation and supervising all activities related to financial service. OJK supervises and regulates financial service in the banking sector, capital market, and EKNB. What the purpose of the OJK? First, it's there to ensure that the financial service sector is structured with fairness and transparency. Second, it's there to help the sector grow with sustainability and stability. Finally, the OJK can intervene to protect consumers and the public if there are financial problems.
The Deposit Insurance Corporation protects the funds of banking customers in Indonesia. LPS protects customers' money in banks and keeps the banking system stable. What is the LPS purpose? LPS is responsible for maintaining the stability of the banking system, guaranteeing customer deposits, and conducting deposit guarantees.
Commercial banks are banks that carry out both conventional and Sharia activities. The function of commercial banks are to collect funds from the public, grant loans, and receive payments. Regulating the circulation of money, providing storage facilities, ensuring smooth payments, and international transactions are some of the functions and duties of commercial banks. Commercial banks are very helpful and facilitators of the public in the financial aspect.
Thank you for watching Group 2 is Financial Institution Explanation. Hopefully it can be useful and add insight. If there are any mistakes, we sincerely apologize. Thank you.